Okay, welcome. Again, we're gonna go ahead and get started. Today's topic is, if you can hear me clearly, just let me know. And you can see my screen, just let me know. All right? Okay, thank you, Rich. So again, today's topic, market structure again. Trend reversal icon. Then trend lines, right? We have to tie in more time analysis. Okay, so basically, right, today we have to cover market structure, and within that market structure, it also involves covering trend reversals and trend continuation, and then trend lines. And with all those topics, we have to be able to use them and identify them with multiple time frame analysis. So basically, we have to be able to identify all these topics on every time frame, right? Right. So again, right, the reason why we learn these are called confluences, by the way. A confluence is basically a reason to enter a trade, right? Right. So in trading, you have to learn the different confluences, the different reasons to enter a trade. And the more confluences that align, the more reasons you have to enter a trade, the more reasons why this trade is going to go in that direction, is the more odds that's going to be in your favor, right? The higher the probability of you being right. Because nothing is sure in trading. That's why we deal with probabilities, right? Where's the market most likely to go? And here's why it's most likely to go that way, right? So we have to understand market structure, which was taught in a previous lesson, but we're going to go a little more deeper into it. And these confluences, right, all tied into the different time frames, right? So just as a recap, we know that market structure is basically how the market moves, right? We know the market moves up, down, and sideways. When it moves up in an uptrend. When it moves sideways, it moves sideways in a consolidation or owl box. And then when it moves down in a downtrend, right? And we know that uptrends are made out of higher highs, right? We know that an uptrend is made out of higher highs and higher lows, right? Uptrend. And we know a downtrend is made out of lower lows and lower highs, right? And then for sideways trend, that's made out of no high highs, no high lows, and no lower highs, low lows, and no lower highs, right? So in order for an uptrend to be an uptrend, it must only have high highs and high lows. If it doesn't, if it has anything else, it's not an uptrend. Downtrend, only lower lows and lower highs, right? And we know what's the high and the low, all right? That's just a recap, right? So now that we have this information, all right, and we know what is a trend, we know it's an uptrend, we know it's a downtrend, we know it's a sideways trend. You being able to identify the trend is one thing, right? The next is being able to know when to take advantage of the trend. How do you take advantage of the trend? How do you use this information to enter the market, right? And in order for you to use this information, you must understand the confluences, the characteristics of the confluences, right? So, for example, and then, well, we'll go through that, right? So, here we have an example of a downtrend, right? This is an example of a downtrend right here, right? Let me get the tool to highlight this. This is an example of a downtrend, right? How do you take advantage of this downtrend? Well, there are two ways, right? You can get in on the trend. That's getting in to a trend continuation. You know, you're expecting the trend to continue down, so you sell to join the trend going down. Or you can wait for a trend reversal. That's simply the end of a downtrend, which would be the beginning of an uptrend, or vice versa, right? So we're going to start with the trend continuation, since that's the easiest one to start off with, right? So let's go over what we know, right? We know downtrends are made out of lower lows and lower highs. So let me just highlight that, right? We'll use this as the lower high, and we'll use this as the lower low, right? So downtrend, right? We have a high, a low, right? Then we have a lower high, and then we have a lower low, right? And then we have a lower high, right? Then we have a lower low, something you should have been practicing. Then we have a lower high, right? Then we have a lower low. Then we have a lower high. Then we have a lower low, right? So here's the key. We know that a downtrend is made out of lower lows and lower highs. We know that the what? No. We know that every lower high has to be lower than the previous high. The reason why it's called a lower high is because it's lower than the previous high, right? So that information is very vital. So we know that if the market is making a lower high here, we identify where was the previous high, which was here, right? I'm gonna highlight this red. We know that was the previous high. And according to the rules of a downtrend, the market has to make a lower high. So the market cannot surpass this level if it's a downtrend, right? So knowing that it's a downtrend and it cannot surpass this level, it has to keep going down every time it makes a lower high, right? With this information, you would use this information to figure out where you're going to enter in the market and where you're going to put your stop loss, right? Your stop loss is basically, which was taught in a previous lesson, is where you would like to get out of the trade if you're wrong, right? So for example, let's say the market was here, right? And nothing else happened, right? And you want to get in on a trade, right? Knowing the information you have, let's say you know this is a low high right here, right? And the market has to make a lower low and then make another lower high, right? So you wait for the market to make that lower low, and when it comes up to make its when it comes up to make a lower high, right? Let me just get one candle, right? You can use this information to safely enter the market, right? Because you know the market cannot surpass this level, what you would do, you could enter a trade right here or wherever once it's under this level, right? With your stop loss, the top of the red box would be a stop loss. With your stop loss above the previous lower high and your take profit below the previous lower low, right? Now, just based off of knowing market structure and knowing this is a downtrend, you know that the market cannot come up and pass this lower high because it's a downtrend. So you know if your stop loss is up here, if that's where what you're willing to risk and what price you'd like to get out of the market, you know that your stop loss is safe. Because the only how the market can hit your stop loss is if you're wrong, right? And if you're wrong, then that means it's not a downtrend, because downtrends only make lower lows and lower highs. So from the minute time the market goes above this price, the minute time the market goes above this price over this previous lower high, you know that it's not a downtrend anymore, because the market only make lower lows and lower highs. So knowing that the market only make lower lows and lower highs, you just follow the trend. You expect it to keep going down. You expect it to keep making lower highs, lower lows. So you get in the trade with your stop loss above the previous high and your target lower than the previous low, right? So as a trader, your goal is to be able to identify those lower highs, because you want to be able to enter your trade at them, because they are the best price to enter at. So once you identify the downtrend, you have to use what you're taught to find the lower highs. So you would probably want to enter a trade here on this high and go down, and you'd want to enter more trades, right? Go down, right? And more, you know, if you could keep adding positions, because that's what you aim for. You aim to enter on those turning points. where the market is turning around to continue going down, you just short it, you just sell, because you're expecting the trend to continue going down. And you want to sell at that highest point so that you're able to ride the trend down, right? So that's what you have to learn. You're able to identify the lower highs. Next, you're gonna have to learn how to pinpoint exactly where that lower high is gonna be formed, and so you can take advantage of that trade, right? So that's how you enter a trend continuation. You're expecting the trend to continue, so you just enter at that lower high. If the trend is up, you're gonna enter at the higher low, right? So let me look for an uptrend. Okay, so this is actually a daily chart. Each candle is 1 day worth of movement. So you see how this market is trending up, low, high, low, high, low, high, low, high, right? You as a trader, you want to get in on these. You want to get in on the lower highs, right? You want to buy at these turning points in the market so that you could ride the trade up and collect those pips, right? So let's say you had entered down here for whatever reason, and you rode this trade all the way up. That's 634 pips. You enter a trade for $1 a pip, that's $634, you know? So that's how you enter on a trend. Well, that's the idea, the concept of trend continuations and how and why you would want to take advantage of them, right? Any questions? Okay, so for the beginners, please look over this video when you get the chance, right? So where there's trend continuation, you can also enter on a trend reversal, right? A trend reversal is more rare, but it is more beneficial and it is more harder to spot, right? So a trend reversal is basically the end of a downtrend or uptrend, right? And you want to enter at that price. So for example, you see that you had a downtrend here, right? And at this moment, that downtrend ended, right? Because you have lower, high, lower high, lower high, right? Lower high, right? So according to the rules, the market cannot surpass the lower high, right? In a downtrend. So from the moment this was broken, a candle formed above this price, the downtrend has ended because the market is no longer making lows and lower highs. You as a trader, if you're doing trend reversals, you want to enter at the end of a trend. So you want to be able to anticipate that the trend is going to end here and be able to buy at that price and ride it up, right? So for example, a few weeks ago, we entered a trade down here, right? We entered at this price because we was expecting the trend to reverse, right? The market came all the way down and almost tapped our stop loss, and then it rolled back up, right? So as a trader, you want to be able to identify those trend reversals early so you can profit from them, right? And how do you identify them? Well, you wait for a break of market structure, which we was going over in the last class, right? A break of market structure looks something like this. You have a downtrend, lower lows and lower highs, right? Then once the market makes a higher high, we have a break of market structure. So once the market passes this previous high, we know that the downtrend has ended. And if the market does pull back, right, we don't expect it to pass this previous low because now it's an uptrend, right? Because it made a higher high. So we're expecting it to make a higher low and continue the trend, right? So there you go. So usually we would want to find this higher low to enter on, or even this low, right, to enter on for the trend reversal, right? So as a trader, you identify your lower lows and lower highs. You identify when there's a break of market structure. The break of market structure comes from the market surpassing this level, right? And then you identify, okay, the trend has changed. The trend is now an uptrend. So now you're not looking to sell, you're only looking to buy and profit from that uptrend, right? Now you're gonna learn more confluences so you know exactly where and what to look for before you enter the trade, right? To profit from it, right? So based on what was taught in this lesson and the previous lesson, I'll show you a live example of how we found a trade using the information that was just taught, right? So we have this this example right here. On the daily chart, Aussie NZD, Australian versus New Zealand dollar. We have the market in a downtrend, right? Right? Lows and low highs, right? So this was the previous lower high. The market came up and surpassed that high, right? So what does that tell me? That tells me that the market was not making lower lows and lower highs. The market just made a high high. So now I'm expecting that when the market does pull back, it doesn't go beyond this low, right? Because I'm expecting it to be an uptrend, so I'm expecting high highs and higher lows. So what happened? We decided to enter a trade around here, and we put our stop loss below the previous low because we're not expecting the market to come down to that low, right? We're expecting the market to stop before it and continue up to make a high high. However, the market did push past that low, which happens sometimes. The market is not perfect, but we are still correct because the market came up and made a higher high, right? It made a higher high, and this trade was up. Let's say, let me count, just probably like 156 pips, right? So from this price down here to up here is 155 pips. If you enter a trade for $1 a pip, $155, right? And then we also we had another entry right here for reasons I have not taught yet, right? But based on what we learned so far, um, that's one of the confluences you could use to identify a trade, right? So you as a trader and as a new student, you would memorize that pattern, right? If it's an uptrend, higher highs, higher lows, and then we know if the market breaks that structure, we could expect the market to be now in a downtrend making lower lows and lower highs, right? And that structure meaning it surpassed the previous lower high, right? So as a trader, as a beginner, you open up your charts, mark out your highs and your lows, mark out when the market broke structure, and just practice, train your eyes to see these things, right? So that you can see them and anticipate them so you can take advantage of them, right? And this goes for every time frame. So you don't just do this on one time frame. You hop on a weekly, you figure out, okay, so these are the weekly highs and lows. Because the weekly highs and lows are not going to be the same as the daily highs and lows, right? And then you go down to the daily, you go down to the 4 hour, you can even go down to the 1 hour, the 1 minute, and identify these market structures so you can actually hop in and take advantage of them, right? So, any other questions before I hop into trend lines? Okay, so trend lines, right? Quick introduction, and we'll go deeper into it. If you're a diligent student, you might have researched trend lines before, right? So basically, a trend line is a tool we use to measure the trend. You can use this tool to measure the trend, measure the health of the trend, and it helps you to find continuation entries and trend reversals, right? So, what is a trend line? A trend line is a line you draw connecting the previous higher lows if it's an uptrend, the last two previous higher lows if it's an uptrend, and the last two previous lower lows if it's a downtrend, right? So let's say we have an uptrend, right? And you need to draw a trend line. What you do, you look for the last previous lower highs, the last two, you take the trend line and you connect them, right? You connect them and you extend it forward, right? Now, what tends to happen is when the market continues and the market decides to pull back to make that higher low, it tends to bounce off that trend line, right? The trend line tends to be the area where the market has a reaction because a lot of traders draw trend lines, right? So a lot of traders put their money in at that price where the market meets the trend line, right? To buy or sell. So as a trader, you would draw out your trend line and you would wait for that market to come back to retest the trend line, right? And then when it comes back to that spot and you align it with some other confluences, here is the area where you would buy. Your stop loss would go below the trend line because if it's a healthy trend, most likely it's not going to go beyond the trend line, right? And your take profit will probably be at the next high or at your target or at your discretion, right? So same for a downtrend. If you're in a downtrend, you connect the two previous lower highs, you extend that two last lower highs, and then when the market is retracing to that trend line, you wait to anticipate what the market is going to do. It's when the market gets to the trend line, it can only do one of two things. It can break or bounce. A bounce is where the market reacts and continues. A break is where the market breaks the trend line, and it could be a potential trend reversal, right? So when it bounces, usually it's just a candle that's just gonna tap the trend line, or a wick that's gonna tap the trend line, and you're gonna get that reaction, so you can enter the trade. When it's breaking a trend line, you would just have a candlestick close beyond the trend line. Once there's a candlestick closed on the other side of the trend line is considered broken, right? And if the trend line is broken, then if the market continues, you wait for the market to come back and retest that trend line, and then you enter to go long. Now, there's something called the last kiss in Forex. So, throughout Forex, when you're analyzing historical data, you realize that there's patterns. And the market tends to like to give the trend line one last kiss before it leaves, right? So even when the market breaks the trend line, you can expect the market to pull back, to tap that line before it heads off, right? So let us see if we can find some live examples, right? So here we have a high, a low, a low high, right? So let's connect them. So here you see how the market reacts, right? We have the high, the low. We have the first two lower highs, right? So let's say none of this happened yet. You as a trader, you're expecting when the market comes back, you're expecting it to tap that line on the third touch for you to enter. So if you were entering just based off trend lines, you'd enter somewhere like here. Once the market comes back to touch the line, your stop loss above, your target below, right? And then you would just ride that trade until you see a break of structure and the trend ends, right? So let's say the market makes some new low lows and low highs, right? You just adjust your trend line to the last two. So this will be the previous high and lower high, and you extend it, right? And then you see, okay, the market came back and tapped it for a third time again. And that's where you want to enter, always on the third tap. You let the first two happen, right? And once the market makes some more lower lows and lower highs, you just adjust them. Adjust your trend line to the last two lower lows and lower highs. And you wait for the market to come back and give it a tap, right? And then you enter short at that third touch. So this is why you need to know how to identify your lower lows and lower highs, so that you can draw your trend line and wait for that third touch, right? So the same way it is for a bearish trend, a downtrend, the same way is for an uptrend, right? Well, let's see if we can find a few uptrend examples. You can see all my charts are marked up. So this is a higher time frame trend line, right? Basically, this is a trend line on the daily time frame. So we had the beginning of a trend right here. We had the high, right? The high and the low high, right? So once we have those first two, the low and the low high, we could draw a trend line and extend it out and wait for the market to come back. Right here, we can see, okay, the market did come back, tapped our line, and went long. Now, if you had entered this trade, let's see, just off trend line confluence, and you roll it all the way up, um that's 1100 pips, right? 1100 pips, a dollar a pip, you know what it is. So again, as a beginner, you hop on your charts, you practice, you draw out your structures, you draw out your market structure, you pass through the time frames, you look for a trend continuation, you look for the trend reversals, you draw out your trend line and you wait and you see how the market reacts to your trend line, right? So trend line is a topic that needs a lot of attention. So the next session is going to be entirely on trend lines. I think 45 minutes should be enough time because this is not the only way you use the trend line, right? But 45 minutes should be enough time to go through the different ways we use trend lines. You see the information that's being taught, it's not that hard, but here's the thing. If you're taught this information today and you don't utilize it, you're gonna forget. And if you don't utilize it, you're not gonna have experience and you're not gonna be confident in your trades. I'm sure if you watch this video and you go on your charts and you practice 100 market structure, 100 trend line, you draw 100 trend lines, you draw 100 trend reversals, you draw 100 trend continuations. After a while, like you train your eyes to see them, you know? So it just becomes natural. Sometimes you don't even have to draw on the charts. And you pick up certain things, you realize, okay, well, this tends to happen, you know? So you make note of it. So whenever you're ready to draw your trend line, you're ready to go back to your charts and look for a nice trade, it's easy because you've done this 100 times already, you know? So please practice. I'm very proud of Rich and um, and a couple other guys and girls. You know, I can see y'all working, and I can see a lot of progress being made. You know, but give it some more priority and some more passion, some more practice, dedication, some more time, and you'll see the result. You know, you'll see, oh, this actually works. You know, but yeah, tomorrow we're gonna go over some more trend lines, and we're gonna stop it here at 45 minutes. Thanks for hopping on. I'll put up the recording in a few minutes, but feel free to do your own research. You know, go on YouTube, go on Google, and just look up the topic we covered today. You know, even if you don't like how I taught it, someone else could probably have showed you, okay, you might understand when if this person taught it. But the way I draw my trend lines, I only do it with the last two lower highs and the last two higher lows. Some people they connect a lot more, but this method is very effective, and I think you should stick to it. You know, so go ahead and practice, and we're gonna stop the class right here. Thanks for hopping on. See you guys tomorrow.